following presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
We are back, everybody. This is Michael Burke. We're joined today for this segment by one of our recurring guests, SpeculatorSeth. Seth, thanks for being here.
Hey, thank you for having me again.
Interesting. I saw the topic that we wanted to talk about today, and it's really one of those topics that I think are universal. But we're gonna, and to be clear, we're going to be talking a little bit about volatility and how volatility can help help a trader pick different key levels, potential for the market, that kind of thing. But volatility can mean different things to different people, right? So let's level set a little bit here. Maybe talk a little bit about the kind of volatility, how you're measuring volatility in this particular application.
Okay, sure. So what I'm going to show you today is really based off of the VIX index. So VIX index is a really complicated computation about what people are paying for puts and calls and all of the different stocks. But it's a measure of how far the index could move. So when I'm thinking volatility, like the simplest way to measure volatility would be the range of the day, or the difference between the open and the max of the high or the low, right? Basically, how far did it move from where it started? How far can it get in a day? And volatility is really important to look at because some of the most significant empirical findings that we found about the markets, things that would be different from just a random walk, because there is a lot of randomness in markets, but things that would be different from a random walk, some of the strongest properties that we have found are in volatility. And that's why there is so much money that are made by options traders and things like that is because of these, like volatility tends to cluster and, change. The volatility for yesterday is a pretty good measure of what the volatility for today will be and things like that.
Yeah, that's a great point. So, let me describe what you said.
Sure.
For everybody a little bit. So there's a way of calculating volatility which is historical. Like you said, with average true range, there's a standard deviation calculation. So you can look at volatility historically, see what it's been, see where we are right now. But the kind of volatility that Seth is talking about, the implied volatility that's calculated using VIX, is really a forward volatility. This is what the market makers and the options traders on those exchanges are projecting based on what they're charging for the options, what the volatility is in the future. And so it's actually a forward-looking range of prices based on that volatility. And I think that can be very useful.
Yeah, exactly. So the two words that you want to remember is implied and realized. The implied volatility is how far is the market expecting things to go, and realized is how far did it actually go. So I actually whipped something up for you guys yesterday that I can show you over here on my screen here. So this is a scatter plot that is showing you the relationship between implied and realized volatility. So if implied volatility perfectly predicted realized volatility, then what you would see is a straight line like this, right? Now you can see it's not a perfectly straight line. So there is, it's kind of more of an oval like this, okay? So there is a pretty strong relationship between the two, but it's complicated. There are some days in particular, these guys up here, where the market isn't expecting that much volatility, but then we end up getting a ton of volatility. I'd also note that there aren't very many days where the market is expecting a ton of volatility and we don't get a whole lot. Like there's not a whole lot down in here. And that's really important, because what that basically means is that there is kind of a lower bound to how far the market is going to move in the day. We can basically say the market is going to move at least X much. And on this chart right here, I don't know if you can see the axis, and you can only see it on the y-axis, but this is in percentage points, right? So most of the time, we're expecting the market to move at least 0.5% or more, right? And that becomes useful because now you kind of have a target. You know, if I'm taking a trade and let's say I just want to take one trade and hold it and try and catch a big swing for the day, you know, that gives you a good first target. I know that the market is probably going to move at least yay much, okay? And so that's where our projected range indicator comes from. So if I come over here to this other page right here, what this is doing, what these lines are doing is they're saying, this is how far the market expects the index to move that day based on the implied volatility. So you can see this, the kind of gray line is where we are when we open. And the way that the indicator works is it measures what the VIX is at the open and what the opening price is, and then calculates how far it expects the market to move. And you will see during most days, so especially strong here in this area, you see they start here, they come up and they come down. They start here, they right as soon as they get to that level, they come off of it. Now that's not, I wouldn't say like, okay, I want to take a reversal there, right? But based on the circumstances, right, that it's going to stay in that area, right, until you get something
Seth, that's interesting.
And then
so you have two lines there. You have two red and two blue. So what do the outer red and blue lines mean?
Okay, so this is like this is just basically twice as much, right? So this is just this is what the market is predicting, and this is like twice what the market is predicting, essentially. So you'll notice when we do get a big move, you know, they will tend to come to that right there, right?
Interesting. So this is kind of interesting. A couple of things that jump out to my mind here is that, and you kind of showed it on the scatter graph a little bit as well, is that there tends to be bigger moves. If you look at the top of that graph, there tends to be these outlier moves occasionally that really moves the market in a big way, and there's not as many of those on the downside. So do you think in general, because of those outliers, that often the VIX or the volatility can be a little bit higher, trying to account for that extra risk?
Yes, exactly. So basically what happens, and the way that the options market makers kind of play this, is that the implied volatility tends to be a little bit greater than the realized volatility. Most of the time, the market does not move as far as the options suggest that they're going to. And that's how the market makers make money, is they're selling the options. Other people are buying the options. The people that buy the options, those options usually expire worthless because it doesn't get beyond the price that they're paying for it, right? But why is that? Why do they price it like that? Because when the market exceeds that implied volatility, it can do so by a lot, and the market can really move in ways that just like nobody can predict. And that's these outliers up here. But like you said, you don't tend to get the outliers down here where the implied volatility is really high and nothing really actually happens.
That is a great way to visualize that.
Yeah, and so, you know, on these bars, and by the way, this is an indicator you can get in my indicator package. You can see it at SpeculatorSeth.com. You can download it, try it for free for 2 weeks, and then a lifetime license is only $100. So it's something really well priced that basically everybody can take advantage of. And if you're going to trade equity indexes, I really think this is something that you should look at. You do have to have VIX data to be able to see this chart. So if you get kinetic data, you can get VIX data, or if you're doing CQG continuum, I think you can pay $10 extra to get those indexes, right? But in terms of how I would use this, I wouldn't say like, okay, when we get up here, I want to take a reversal on anticipation that it's going to come back down, right? But what it does tend to be very, very good at is a profit target, right? Like if I'm taking a swing, I want to get this. That's my goal, is I want to catch this swing. If I'm expecting a big move for the day, then I want it to go beyond that. I'm expecting it to go somewhere in here. Now it can go above that top line, but pretty rare, like maybe 5% of the time. So they make extremely effective targets. And if you are trading indexes, it is something that I really don't see how people trade without looking at the volatility. It's one of the most important and best empirical tools that we have.
Yeah, I completely agree with that. So this is the VIX on the ES. I don't think we have the data available, but there's also a VIX for the NASDAQ. So you could actually use this on a couple of different markets.
So let me show you real quick on the indicator settings here. So you can specify the volatility index that you're going to use. So I've actually tried it with the treasuries. Maybe I should check with the data. I didn't think to do this, but there is a move index for treasuries so that you can see volatility for treasuries. And then there is also a factor right here. So that's basically you divide the VIX by that factor, and that's how you convert between, okay, the VIX is like how much it's going to move between, like within an expiration. So how do you scale that down to a day? Some people say 20, some people say 16. I'm using 16 because, that's where you get, because you want this line, you want this line right here, and that's how you get a good line. So that's why we use 16.
Got it.
Seems to scale best for what we're doing. But so you can adjust it to other things if you have the data.
Yeah, that's great. So that's another good point, is that you want to kind of think about volatility in terms of options expiration as well. So basically, do you adjust this for or do you look at it differently when you're in a week of options expiration? I think we're coming up on an options expiration week next week. So would you do anything differently here, or basically that's really not a factor as you're looking at those levels?
No. So the expiration is really important, and that's definitely going to change my strategy and like expected flows. But I don't have to change anything with the indicator because the VIX index pretty effectively adjusts for that, right? They're using multiple different expirations and so forth to be able to calculate these numbers.
I got it. That's interesting. Let's go back to that to the VIX chart there for a little bit. Can you spread that out just a little kind of bit there? Because there are some interesting moves here that maybe you can talk to some of the different ways that you would look at some of these patterns. Like that day right there is an interesting day where you have a move up into the that first level, and then it really kind of stays in that level for the entire day. So it kind of plays out right that here. Move. So maybe talk a little bit about some of the different ways that this manifests and how you look at it.
Yeah, well, so this move was kind of interesting because I would say that it was like mostly an overnight sort of a thing, like, or at the very beginning of the session. So it's kind of like they moved up, and then that established a new range. So this kind of point right here kind of became the new open, and then they just traded within that, right?
And
this
that kind of
day
became a support level. And I've noticed that a couple of times that these levels can either be a support or resistance level, at different times during the same session.
Yes. And this move right here, by the way, that was non-farms. So like non-farms came, the market opened up, and then that was when they went and they made it to full target. So it is, sometimes it's almost prescient. Like it's kind of funny because when you look at the scatter plot, you can see that it's pretty diffuse. This is like 10 years of data, by the way, that you're looking at right here.
Right.
But the number of times that it seems like it will come almost exactly to that line sometimes is a little scary. But the options are a significant amount of the market volume and everything out there. So those kind of levels do matter. I think though that like this area right here, this is kind of more what's typical, is like if there's not some huge market moving moves that's really adjusting people's expectations and really resulting in strong flows, we're just kind of getting regular trade. We tend to stay within those lines.
Yeah, that brings up an interesting point, and that is that over the last 2 or 3 months, we've seen VIX really kind of settle into a channel that's between 1250 and 15.
Yeah.
And
so here's the chart with the actual VIX on it.
And so what's interesting about
down at 12. Oof.
Yeah, what's interesting about that in my mind is that the level of VIX, typically, I mean, even though it's low now and we're seeing the price action between your levels, if VIX were suddenly to jump up to between 15 and 1750, we would still see the prices moving between those levels, even though those levels are going to be farther apart.
Yep. So it's adjusting. So, because the change is subtle, you might not be able to tell, but the difference between these lines is a little bit different every day because it adjusts for the volatility. Yes.
Do you subscribe to the idea that when VIX is in kind of these low levels, that's bullish for the market, and that really, this is kind of outside the talking points of your levels, but in general, do you think the level of VIX can give traders a hint at the bias of those market makers on those options exchanges?
Well, so in terms of it being like bullish or bearish, I mean, generally speaking, yeah, the lower the VIX is, the more bullish it is, because trader or investors more generally don't like volatility. They don't like uncertainty. They don't like, the possibility of a loss. And so the less it's more consistently it's moving, the less volatility there is, the safer of an investment environment. But what's going on right now really is that despite having raised interest rates so much as of late, there is still some very deflationary kind of factors out in the global economy right now, right? Like we're making so many efficiency improvements that it's really hard to get inflation. They have to print a lot of money to get that 2% target in normal times. Like before COVID, they weren't reaching their 2% target, right? And as they do that, as they flood the world with liquidity, and we've got a decent amount of liquidity right now because rates have come off, that suppresses volatility. And that is something very, very important for retail traders, especially if, because so many people came in during the 2020 pandemic. You probably haven't seen this before. When I started trading in 2017, I started my YouTube channel because of a contest on the Futures IO where they wanted to do a video journal. And I was the only person that did it. And now there's so many people on YouTube, so many people that are traders, like there's tons of them, right? Why was it like that in 2017? Because volatility was like at these levels, like 12. Trading was really, really hard. It was a completely different, and the best way to trade was usually for these guys to fade the move and bet on mean reversion, which, hasn't been the last 4 years. So it is kind of telling you something here. Volatility may spike back up after the summer. So that's something to watch for. But if we get into like next year and everything is kind of still hunky-dory and goes along the way that people are anticipating, then you could continue to get this super low volatility regime. And that really, really changes your trading. It makes trading hard. It does, because the market's not moving as much.
I totally agree with that. The other thing that I think we've seen over the years is all of these different products and different things that you can trade, which also reduces volatility. So there's if you can't get in here or out here, there's somewhere else you can get in or out. And that accessibility to the markets, I think, in general, lowers volatility.
Oh yeah, for sure. And again, going back to the thing, right? As we're lowering volatility, what it does is it kind of creates these things over here. Like think of all of these beads as like a physical thing, and you're like squeezing it and you're trying to squeeze it down, then some of them are going to pop out, right? And that's what happens. That's what happened in 2018, right? We went from a really low volatility regime to all of the sudden 1 month volatility just like blew out the roof, because everybody was basically going into the VIX futures and just going short the VIX futures every day. And then one day that trade blew up, and oh my gosh, I'd never seen so much volatility. It was like all of a sudden the treasuries were trading on less than 200 contracts. It was wild, right? And that sort of thing is now more likely because of that setup. Like I'm sure it will happen again. Who knows when?
Yeah, but that's a very interesting. That was a very interesting time. There was this volatility trade that was very consistent for long periods of time. Everybody was piling in. It was like, this works, until it didn't work. And then a lot of people got killed in that 1 day move. And the ETF became insoluble, whatever that word is. Sorry.
Right.
And that was just a mess. And I think from that point forward, we've just seen this increasing decline of volatility over time. And those kinds of opportunities for it to spike up, those can happen, but it's not the same magnitude that the potential is today that it was then.
Yeah. So I see there in chat, one of the guys that's frequently on my stream, Francesco, talking about this, that they will sell both the VIX options and options on the index and then buy single stock options for a dispersion trade. But you're right. Like there's more and more things that keep piling on to be like, hey, sell volatility. And the problem is that there's a fat tail to it, right? So it's going to work most of the time until it doesn't work, and then
until it doesn't
look
work.
out.
That's
and
right.
and when you're trading that, the whole thing becomes about, can you see when the tail is happening, right? How fast do you react to the tail? Because that's going to determine whether you make it or not.
Yep, exactly. Seth, this was really fantastic. I love that indicator. How can people get in touch with you?
Yeah, so I have a YouTube channel, SpeculatorSeth, and everything's from there. I also, if you want the indicators, go to SpeculatorSeth.com, have everything that's there. I'm also super available, so you want to talk to me, just come on to my stream, and I answer any question that you have, because we have a small intimate stream where people can ask questions. That's the great thing about our thing. So it's really easy.
So thanks so much for being with us. So hopefully we can do this again real soon.
Yeah, thank you very much. I have more to show you. I have another one that's for news, but we'll show you that next time.
Okay, I'm sorry we ran out of time. That's my fault. Sorry.
Oh no. We're only going to talk about the VIX today, but the news one, we got some back testing with news stuff that I think is really useful too, that we can show.
Oh, that's excellent.
All All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involve substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.